The Take Action webinar series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Okay, thank you everybody for joining us today for the Bucket Plan, Holistic Planning Process and Best-Selling Book. Looks like we have quite a few people that have already logged on, a few more coming in, but we're going to go ahead and get started. I'd like to introduce you to your speaker today, Jason L. Smith. As you can see on your screen, Jason is the founder and chairman of several different organizations, Clarity to Prosperity, which is the training company, Prosperity Capital Advisors, which is the RIA, C2P Advisory Group, which is a fiduciary-friendly insurance marketing organization, and he also has a successful retail practice, the JL Smith Group out of Ohio. Jason is the creator of the Bucket Plan, the planning process that we'll be reviewing today, as well as the premise to the book, The Bucket Plan. I'm sure many of you have seen Jason around the industry. He's a regular speaker at many events, including the MDRT's Top of the Table annual meeting. He's been at Forum 400, at Slot & Company, and is a great speaker at these different industry conferences. He's been recognized by a number of different organizations for the accomplishments that he's had in his career. Was named an emerging leader and legend by Forum 400. He was a top 40 under 40 industry standout by Investment News, and has been named the best rising star by National Underwriter magazine. He's the author of several different books, Clarity to Prosperity, an advisor's guide to charging planning fees, as well as the Bucket Plan, protecting and growing your assets for a worry-free retirement. And Jason's regularly sourced by national and industry media on a variety of topics related to financial planning, regulation, etc. The Bucket Plan book has experienced some recent successes. The book came out about a month ago and has been highly acclaimed by national media across the country. Kiplinger Magazine has named it as one of its top strategies to generate a retirement income. It's actually the first strategy that's listed in an upcoming article. It is the feature story for the October issue of Kiplinger. Chicago Tribune reporter there said that he believes the Bucket Plan can help you work toward that peace of mind, no matter what shape your finances are in or how close to retirement you are. Think Advisor, Yahoo Finance, quite a few podcasts and different articles are still coming about the Bucket Plan book and Jason Smith's approach to planning for retirement. It also is an Amazon bestseller. It was an Amazon bestseller within the first couple of days of the book being released in both the retirement planning and the wealth management categories. So without further ado, I'd like to introduce you to Jason Smith, our presenter for today's webinar.
Thank you, Alana. I appreciate the kind introduction. So we are going to be talking about the best interest process. The holistic planning is like what we like to call it, process that's been built around the Bucket Plan philosophy of bucketing your money. And also talk a little bit about the book throughout. So where this is coming from, we want to just briefly introduce you to Clarity to Prosperity. It's a process development, training, and coaching company specifically for elite financial planners. There's different ways to access the programs that are within this company. But this company is not an FMO, it's not an RIA, it's a standalone training and coaching company that develops all of the most successful processes from top advisors throughout the industry. I've been in top of the table for over a decade. I've been in this industry for over 20 years, and I've always been attracted, to the rock stars, to the people that are doing things, really special and in a different way, that are growing their business and bringing on a lot of clients and a lot of new assets and doing it in a very fiduciary friendly way. So what I've been able to do throughout my years in my career is I've been able to connect with some of the top planners in the industry And we've come together under this umbrella called Clarity to Prosperity. And so top planners, hundreds from all across the country, we get together a couple times a year. We share best practices. We help each other grow our businesses. We're all like-minded. We're all financial planning based, rowing the boat in the same direction, gathering a lot of new assets and utilizing insurance products as solutions for our clients. We very much so believe in the holistic planning approach. One of the big differences, I've been affiliated with a lot of FMOs and RIAs throughout the years. And at the end of the day, they were really focused on gross production, how much business I write. They weren't really caring about my individual practice and my net profitability. So as an organization, one thing that we stand for, because we all are advisors, and I'm a financial planner, I still run my own practice and meet with clients, is I understand that it's not about what you make, it's about what you keep. So a focus on net profitability through proven processes that have been executed out in the field by the advisors that are part of Clarity to Prosperity. So leading through example is something I'm proud to say that I do, as well as all the coaches and mentors that are affiliated with our organization. And the big difference of what you'll find from other training companies, other coaching companies, is that we don't just tell you how to go out there and document and create systems and processes. We for you. So we take a lot of the lion's share into audios, videos, scripts, checklists, letter templates, flow charts, everything that you and your team would need built out into an online e-learning university style platform that you can plug into and private label all of the different processes into your own individual business, whether it be marketing, practice management, or the financial planning process, which is what we're going to talk about here. So first one I want to start with is I want to talk about our fact finder. This fact finder, I've taken some of the best questions that I've learned from all the top planners and advisors across the industry throughout the years, and we built it into a very succinct, very strategic way of how to ask and when to ask these questions. Very comprehensive, gives you all the information you need to know, not only to meet a best interest standard, which is very important in light of all the industry regulation, but also to be able to really build the relationship with the client. Ask questions that maybe no one has ever asked before. If you've been reading part of the page on the screen, Dan Sullivan, a strategic coach, has allowed us to utilize one of the questions. It's a hallmark of his program, and there's many, many more that are baked into this fact finder. It's the best fact finder in the industry because we've been able to borrow and modify and utilize all the best questions that top planners and asset gatherers around the country are using. One of the unique things we do too is at the end of the fact finder, the last page is the initial concerns ranking worksheet. And so what we do is when we ask them about, are there any dangers, concerns, fears, anything, that, if hypothetically something kept you up at night, what might that be? These are some of those most common answers we've gotten from clients through the years. We have them rank those from 1 to 3. 1 is, they're very concerned about it. It's a top priority. 3, not at all, not even on the radar, not a concern. 2, it's important, but it's not a number 1. Gives us phenomenal insight into the client and what they're thinking and what their priorities are, because too often us as planners and advisors, we get too caught up in our own agenda when really what we need to be making it is all about them. And that's what this document and this facilitating this conversation as you do this with a client is very powerful, and especially when you get to the end of the meeting and you can go back to those number 1s and reinforce why they need to hire you as their planner, as their advisor, to take them through this process. The process itself has, after we've done the fact finder, we really have 6 steps that we take prospective client through. And so we're going to break these down kind of two at a time because they really kind of go hand in hand with each other. But this is the order that we go through the process. So first of all, let's talk about educating on the money cycle and the bucket plan philosophy. The money cycle is a way that we basically explain sequence of returns risk. We have a lot of other tools that we've identified, successful ways to, in a simple way, explain to the client the danger of having down returns early in retirement, pulling off of that money, and then you can never make that money back. You can have a very negative outcome on at the end of your retirement if you experience a downturn and you're drawing off the assets. So the money cycle, traditionally what we see is people go from the accumulation phase and then they go directly into distribution. And too often they continue to invest the money as if they're preparing for retirement, or it's a long ways out when they're already retired or about to retire. And the biggest mistake people make is they continue or are invested as if they're in the accumulation phase when they've actually gone into a distribution phase or are about to. So one of the things we educate people on is the importance of, really there should be 3 phases to the money cycle, and we've added the preservation phase. So the accumulation phase is when you're younger and you're working and you're preparing for retirement and you have a long time horizon before you'll need those assets. And you can afford the volatility and the ups and downs of the market because, let's face it, if you lose the money, you're still working, you can make that money back. Or if there's a big crash in the market, you can wait for it to come back. But as we enter retirement or nearing retirement, it's very important that we preserve a portion of that money in the second phase, the preservation phase. We're going to preserve a portion of that money that we'll draw off of throughout the first phase of retirement in preparation for the third phase, distribution, the final phase, distribution to ourselves in retirement and distribution to our family upon our passing. So this is one of the ways that we educate the prospective client on the importance of setting up a preservation phase or going through a preservation phase in preparation for distribution. Again, we have other resources to explain sequence of returns risk, but this is a high-level, simplified way to explain the importance of preserving a portion of your assets. Now, this sets up the bucket plan philosophy. The bucket plan is an asset positioning philosophy. So the purpose of this is to segment your money based on the time horizon and the purpose of that money. And in explaining it to a client, I might say, Mr. and Mrs. After I've explained the money cycle, I'll say, now the reason, so what we do is we subscribe to a simple 3-bucket approach. And the difference that you're going to see is in this middle bucket, the soon bucket. That is your preservation money that you're going to draw off of throughout the first phase of retirement. See, the now bucket is your safe and liquid money. It's the money you're going to keep in the bank. You are not going to invest this money. You're willing to sacrifice the rate of return you otherwise earn if you were to invest the money to have it completely safe and liquid. So if you're already retired or about to retire, we're going to put up to 12 months worth of income in that bucket to buy that first year's worth of income for however much we'll need to draw off your liquid investable assets. In addition to that, we want to make sure there's an emergency or comfort fund, a certain amount of money that's going to give you the peace of mind to put your head on the pillow at night, to know it's sitting there in checking and savings. It's sitting there safe in the bank. Everybody has a certain magic number. We're going to help you come up with that number and make sure that money is there in the bank. And then lastly, planned expenses. Any large planned expenses you have on the time horizon in the next few years, we want to set that money aside. We don't want to invest it. We don't want to tie it up. We don't want to subject it to market volatility, because if we're going to need that money pretty darn soon in the now bucket, we want to go ahead and put it there and make sure it's safe and liquid. So once we've established a now bucket, it's a simple 2-bucket approach, the soon and the later bucket. The soon bucket is the money that you may need sooner rather than later. It's the money that you may need to draw off of throughout the first phase of retirement. It's maybe the money that you might need to take required minimum distributions from, or it's just that money that you want to take a more conservative approach in case you need to take withdrawals sooner rather than later. We don't want to subject it to the volatility and the ups and downs of the full swing of the market, because if we were to need that money sooner rather than later and the market was down, we'd have to sell it out and we'd never be able to make that money back. So by establishing a now and a soon bucket, what we've done is we bought ourselves a time horizon to confidently invest the rest of the money in the later bucket. And the later bucket, the purpose there is long-term growth and legacy planning. Now, when I say legacy planning, you might say, Jason, you know what? My kids are raised. I'm not worried about whatever's left is left. How many times have we heard that? But see, legacy planning is not just for the kids. Legacy planning is most importantly for the surviving spouse. Because when one spouse passes away, have you ever considered what happens to the income? If that spouse is working or if you're both on Social Security, does the income go down when one spouse passes away? Yes, it always does. Yet, what happens to the taxes when one spouse passes away? On married filing jointly, you have double the standard deduction, double the personal exemption. That gets cut in half for a single filer, a widow. And so now, not only does your income go down due to loss of Social Security or income income from work, but in addition to that, taxes can go up exponentially for the surviving spouse because you lose a couple of the biggest deductions and all the brackets shrink. For the same amount of income, you can pay up to 66% more tax liability for the surviving spouse for that same amount of income. So we explain this three-bucket approach, and the main two things we're trying to hammer home is the importance of having that preservation bucket, that soon bucket, and they're going to have an eye-opener that they probably don't have it. And in that later bucket, no one has ever talked about legacy planning for the surviving spouse. Very powerful conversation. So now what we've done in the money cycle, we created the need. In the bucket plan philosophy, we talked about the solution. And so now throughout the next three steps of the process, and we'll talk about 3 and 4 together, in the asset sheet questionnaire and the income gap, it's information that we need to be able to build a retirement income plan for these prospective clients. So one thing we'll do is we'll do an asset sheet questionnaire. So when they bring in all their statements, all their information, we're going to go ahead and we're going to document everything out in the asset sheet questionnaire. I'm an Ed Slott, a lead IRA advisor. One of the things Ed Slott has taught me through the years is how important it is to get the beneficiary designation information, the cost basis information, the asset titling information to see if it's going to avoid probate or if you're going to subject your clients to have to go through that lengthy process of probate. So a lot of these different things are what we're going to document in here of all their different assets, including debt and any tax liability they're going to have on pre-tax, tax qualified, tax time bomb money. We're going to plant some seeds. We're going to identify what that liability is throughout this asset sheet questionnaire. But most importantly, we're going to get all the relevant information, all the documented information to make the most appropriate recommendations that are in the client's best interest. The income gap assessment is a very simple tool that we've developed. Now, sometimes you're going to need to go through a full budget process and use retirement planning software. No doubt about it. That does happen. But in many cases, when you're dealing with a pre-retiree or a retiree, you're going to simply be able to take basically in the first this is a shortcut to a full-blown budget. In my opinion, it's much more accurate. So if someone's retiring in the next 5 years, we're already retired, this is a very appropriate tool to use and much more efficient to get to the income gap, to the number that you need to build in their plan. So in the first section, current amount deposited into checking, net income after taxes. So we're taking the net after-tax income that they're receiving and living off of in their checking account. In this case, Jerry and Irene were both working. This is what they were living off of, $57,000 a year total between the two. Now, upon retirement, asking the question, if we could replace the same amount of income you're living off of now, and we could have that same income in retirement, would that be sufficient? Most people are absolutely going to be able to live off of what they're currently living off of now. Some expenses go up a little, some a little bit may go down, and we're going to make those adjustments down in that third category. But the second category is the fixed income in retirement. So pension, Social Security, anything that they're going to be able to rely on through the rest of their life in retirement, fixed monthly income sources. So in this example, they both were going to get Social Security. That's $20,000 a year. So we have a $57,000 annual income. $20,000 is offset by the Social Security. So now the third section is adjustments. Any major expenses that are changing in retirement, anything going up, anything going down. They might have a huge travel budget. They might have additional tax liability. They might be paying off a lake cabin, like in this example. This is where you make your adjustments. And so in this example, $1,000 a month they're paying for a mortgage, and that's going to be gone. It's almost paid off. And so $12,000 a year is going to be going away. So if we take the 57 and we back out the 32, we have our income gap of $25,000 a year. Nice form to create a shortcut. Make sure you take pictures. So the next section we're going to talk about is volatility tolerance analysis and designing the bucket plan. So in the volatility tolerance analysis, what's unique about this, there's a lot of risk assessments out there. There's a ton of them out there, but we've yet to find one that scores the bucket separately. So what we did is we took all the best questions we could find from all the risk assessments out there. We ran it by some university professors at some of the colleges that graduate the CFP courses, and to add validity to it. And amongst several hundreds of advisors that have tested this out in the field. And through the years, we've made a lot of tweaks, and we've come up with our volatility tolerance analysis. So one of the big things we wanted to do is keep it short and simple. So the soon bucket has a scoring. The later bucket has a separate scoring. And so we score the buckets separately. And that's what's very different about this. Taking someone through this entire questionnaire is about a 10-minute process. It's not a lengthy process. But at the outcome of it, they're going to have told you how conservative or aggressive that they want to invest in their soon bucket separately from their later bucket, because different time horizons, different purpose of the money. Very important to score the bucket separately. So in this case, the soon bucket scored a stable category. The later bucket scored a growth category. And so now we have better insight of how they want their money invested in respectively in each of these buckets. The last step to the process is designing their bucket plan. So I'm going to kind of take you through how we go about designing their buckets. So in the now bucket, we're going to facilitate a conversation of what their magic number is. Remember, we said everybody has a, put your head on the pillow and sleep at night magic number. An emergency fund, in this case, $35,000 is what they said they wanted in their emergency fund. Always kind of sitting there safe and liquid, not going to be used for income or planned expenses. The second, when we talked about planned expenses, is they wanted to trade in their current car and upgrade their car, and they wanted $15,000 that they would need approximately to put down. They didn't want car payments, and so $15,000 was the planned expense component. In this case, they were not retiring for 2 to 3 years, so we did not need to put up to 12 months worth of income in the now bucket, only the emergency fund and only the planned expenses. So we have a total of $50,000. Now in the soon bucket, and those are going to go basically in the bank. In the soon bucket, we have Joe's IRA. Now, how much was that income gap? $25,000, remember? So what we do is very simple, and simple for the client. I like to try to keep everything very simple. Too often, we get caught up in our own industry lingo and how to do things. But, if we simply buy a 10-year time horizon, and let the market do what it does in the later bucket, so $25,000 a year times 10 years, $250,000. And we're going to use Joe's IRA money because in looking, and doing our due diligence, we knew if Social Security was the only portion of income, they were going to be able to draw off their pre-tax, tax-qualified, tax time bomb money, the IRA money that they're in a partnership with the federal government on. We're going to be able to draw off of those funds with little to no tax liability because their only other source of income being Social Security. So we're going to draw off Joe's IRA, and as an inflation hedge, because as milk, bread, gas, eggs, everything gets a little expensive as time goes on, we're going to be able to draw a little bit more every year to keep up with inflation. So we're going to put an inflation hedge in there of Sally's IRA. And so those are the two components that make up the soon bucket. And we're using IRA money to start to diffuse that tax time bomb to leave the good money as much as we can in the later bucket for the surviving spouse and the family upon their passing for tax efficiency purposes. In addition to that, we know we're going to have required minimum distribution, so we want to use a portion of Joe and Sally's IRA. So the total there is $312,500. We're going to use, one of the questions we ask on the income gap assessment is there a portion of your money, or what percentage of the money do you want guaranteed? In this case, they wanted to have their baseline income guaranteed, but we're willing to invest the inflation hedge money in a very conservative portfolio or stable portfolio. So we used an annuity to guarantee the income, the $25,000 a year to buy the 10-year time horizon, and then a stable portfolio of Sally's IRA. In the later bucket, we have the remainder of Joe's IRA, the remainder of Sally's IRA, and then they have a joint non-qualified account of $365,000. Well, remember, just like they scored stable in the soon bucket on the volatility tolerance analysis, in the later bucket, they scored growth. So that remaining $502,500, we invested in a pre-tax growth portfolio for the two IRAs and a tax-managed growth portfolio for, managed for tax efficiency with loss harvesting in the with the non-qualified money, so we don't have a bunch of dividends and interest in long-term and short-term capital gains showing up on their tax return. So this is a very abbreviated, overview of the six-step process. One of the key things is, in light of what's going on with the DOL, however that ends up laying out, you still need to strive to meet a best interest standard. I believe that's here to stay. This is a quote directly out of the DOL. Advisors can usually prove they have acted in the client's best interest by documenting use of a reasonable process. That's what we do. That's what we just showed you how we do. And it's a very, very powerful process, not only to meet the client's best interest, but to close a lot more business and to do it in a much more efficient, effective way by taking a financial planning approach without complicating things with 80-page software reports and all kinds of complexity. We like to keep it simple for the advisor and keep it simple for the client. One of the key things we do, and this is in the book, is the financial health scorecard. So after they read the bucket plan book and they have an overview of the process, and we explain sequence of returns risk, or i.e. the money cycle, one way to do it, but we do it other ways in the book. We create the need for them to want their own bucket plan. And we give an overview of the process. The book's written as a fable. And at the end of the book, your client, your prospective client that you give the book to, fills out a financial health scorecard. So they score their own planning. What have they done and what haven't they done? And so as they go through this, it's very eye-opening. A friend of mine, a very big marketer in the industry, his name's Joe Polish. He says, the key is to creating the need, you have to open a wound and pour salt in it. Now that's a little bit of drastic, but it's still, when he said that to me, it really reminded me of the scorecard. They are the ones scoring themselves, and they're understanding where they fall and who doesn't want to improve their own score. So this is a powerful tool for prospective clients to go through and score themselves via the scorecard. So now, talking about the bucket plan, you actually, if you become a bucket plan advisor, we have a certification process, an online training, and also a live training where we do role playing. We teach a concept, we break you off into your role play using the tools so you're confident when you go in front of your client for the first time. And then we have a group discussion. We do that over and over again for a day and a half. And if you picked up anything in this presentation so far, times that by at least 20 is what you're going to get in that day and a half live training. And you have the ability to write the preface for this book once you go through the certification, and your name will appear at the top of the book there, as well as on the back with your picture in your preface on the book with myself and with Ed Slott writing the foreword. So after this webinar, we're going to send you out email. We're going to send you the podcast that was recorded of one of our advisors, MDRT. He spoke on the main platform a few years ago. This is one of the top advisors in the country by far. I mean, this is the top 1% of the 1%, Dave Buchwald. And so you're going to be able to listen to him and how he's applied the bucket plan into his own financial planning practice and what he's done, success strategies to implement it, and the difference it's made in his business. In addition to that, we're going to send you a different scorecard. We're going to send you a scorecard for you to score your own sales financial planning process to see how much you're on track to meeting the best interest standard. So this is a best interest process scorecard. So where you'll be able to, I think it'll be enlightening for you to take a look at your own situation and what you're doing with a client and see if you want to improve your score.
The Take Action webinar series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach to advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.